Is the UK economy really on the edge of collapse? Or are we witnessing a painful transformation that few truly understand? Prices are rising, businesses are shrinking, and ordinary families are feeling the pressure like never before. Behind every headline lies a deeper story of shifting power, fragile confidence, and global disruption. From inflation and energy shocks to political chaos and debt, the warning signs are everywhere. But what's really driving this downturn? And can it be reversed before it's too late? Stay tuned as we uncover the 10. Number 1. Declining business, confidence and investment. The UK's economic slowdown has been heavily shaped by a sharp fall in business confidence and investment, which economists view as the most critical factor driving stagnation. When companies hesitate to expand, hire, or innovate, the entire economy begins to lose momentum. Over the past few years, political shifts, volatile tax policies, and global uncertainty have made investors wary of long-term commitments in the UK. This hesitation has created a ripple effect across industries, from manufacturing to technology, as firms scale back plans, delay spending, and hold on to cash rather than reinvesting in growth. The result is a cycle of reduced productivity, fewer new jobs, and slower economic recovery, which deepens public concern and fuels further instability. Many businesses cite unpredictable government policies as a key reason for their lack of confidence. Frequent changes in leadership and economic direction make it difficult for entrepreneurs to plan ahead. For example, sudden adjustments to corporate tax rates or trade regulations can disrupt carefully built financial forecasts overnight. Small and medium-sized enterprises, which make up the backbone of the UK economy, are particularly vulnerable to these shifts. Without consistent support or clarity from policymakers, they often delay taking risks that could boost national productivity. This hesitation weakens innovation, reduces competitiveness, and limits the flow of investment that is essential for sustaining long-term growth. The impact extends beyond boardrooms and balance sheets. It touches everyday life. When businesses reduce investments, fewer projects are launched, fewer employees are hired, and consumer spending gradually slows. Over time, this creates a perception that the economy is stuck in neutral, which discourages optimism across both domestic and international markets. To restore momentum, the UK needs a stable policy environment that encourages strategic risk-taking and rewards innovation. Economic resilience depends on restoring faith in the future, where businesses feel confident to invest, expand, and create opportunities once again. A sustained rise in business confidence would not only strengthen corporate performance, but also reignite public optimism, signalling that the UK economy still holds the potential for renewal and long-term recovery. Number 2. Inflation and interest rate struggles. One of the most pressing challenges weighing on the UK economy is the persistent battle between inflation and interest rates. Over the past few years, prices for everyday essentials, from food to fuel, have surged at a pace that wages simply haven't matched. The Bank of England has responded with a series of aggressive interest rate hikes aimed at cooling inflation, but these measures have come at a cost. Higher borrowing costs have placed immense pressure on households, mortgage holders, and businesses alike. For many families, monthly budgets have tightened as mortgage payments rise and credit becomes harder to access. For small enterprises, the increased cost of loans has limited expansion plans, reducing investment and hiring. This balancing act between curbing inflation and sustaining growth has become one of the most difficult dilemmas for UK policymakers. The core issue lies in the delicate trade-off between economic stability and consumer spending. When interest rates rise, inflation can gradually slow, but spending and investment often decline at the same time. This can cause businesses to face lower demand, leading to layoffs or price adjustments that further weaken economic activity. Meanwhile, essential goods remain expensive. meaning that even if inflation percentages fall, people still feel the pinch. The psychological impact of inflation, seeing prices climb while paychecks stagnate, erodes consumer confidence, making households more cautious with their money. This cautious behaviour can suppress the very economic momentum needed to recover from downturns, creating a feedback loop that traps growth in a low gear. Looking ahead, rebuilding economic confidence will require a careful recalibration of monetary policy. If rates remain too high for too long, investment could freeze and consumer demand could collapse. Yet lowering them too soon risks reigniting inflation. The challenge is to find a sustainable middle ground that controls rising prices without suffocating growth. The solution lies in targeted support for energy costs, housing stability, and small business investment, areas most affected by the interest rate squeeze. A steady hand, clear communication, and consistent policy direction are essential to break the inflationary cycle and steer the UK economy toward renewed stability and resilience. Number 3. Global market pressures and supply chain disruptions. The UK economy has faced mounting strain from global market pressures and persistent supply chain disruptions, which continue to ripple through every major industry. Events such as the pandemic, geopolitical conflicts, and trade realignments have revealed just how interconnected and fragile modern supply networks have become. British manufacturers, retailers, and service providers now deal with higher import costs, delivery delays, and shortages of essential materials that once moved freely across borders. These disruptions have driven up prices for both businesses and consumers, forcing companies to either absorb higher costs or pass them along to the public. The result has been slower production, reduced exports, and weakened competitiveness in a global marketplace that moves faster than ever before. One of the biggest challenges stems from the UK's reliance on international supply chains for raw materials and goods. When global shipping routes stall or international demand surges, local industries find themselves vulnerable. The aftershocks of the pandemic left warehouses empty and shipping containers stranded, while the ongoing effects of geopolitical tensions, especially in Europe and the Middle East, continue to raise energy and transportation costs. These external pressures make it harder for British companies to plan long-term, especially smaller firms that lack the resources to absorb repeated shocks. The knock-on effect can be seen across construction, technology, and food production, where delays and rising expenses have become the new normal. To adapt, the UK must rethink its approach to trade resilience. Investing in domestic production capacity, diversifying supply routes, and embracing new technologies such as automation could help safeguard against future disruptions. Encouraging local innovation and building stronger regional trade partnerships would also reduce overdependence on fragile global systems. Businesses that once relied on predictable international flows are now exploring more flexible sourcing strategies. This transition may take time, but it represents an opportunity to build a more self-sufficient economy capable of withstanding global turbulence. The lesson is clear. Economic recovery will depend on adaptability, collaboration, and the ability to anticipate change in a world where global pressures can reshape national fortunes overnight. Number 4. Weak productivity growth. A major obstacle holding back the UK economy is weak productivity growth, a long-term issue that continues to limit the nation's ability to generate wealth and compete globally. Productivity measures how much value workers create for every hour worked, and for more than a decade, that figure has barely moved in the UK. Despite advances in technology and education, output per worker has remained stagnant, leaving the economy struggling to grow sustainably. This productivity slowdown means that even when employment levels are high, the overall performance of the economy doesn't improve at the same pace. It's like running on a treadmill. A lot of effort, but little forward progress. The result is slower wage growth, reduced competitiveness, and less room for public investment in vital areas like healthcare and infrastructure. Experts often point to low business investment and outdated infrastructure as key reasons for this stagnation. Many companies have hesitated to adopt automation, digital transformation, or upskilling programs that could boost efficiency. Years of economic uncertainty, combined with the after-effects of Brexit and global shocks, have made firms cautious about spending on innovation. Additionally, underinvestment in transport, broadband, and regional development has left many parts of the country lagging behind, creating deep economic divides between major cities and smaller towns. These imbalances mean that productivity gains are concentrated in only a few sectors, while others remain stagnant, dragging down national averages and reducing overall growth potential. To overcome this challenge, the UK must focus on innovation, education, and modern infrastructure. Encouraging investment in research, renewable energy, and digital technology could help industries evolve faster. Equally, improving skills training would empower workers to adapt to a rapidly changing job market, allowing businesses to operate more efficiently. A coordinated strategy that links government policy, private investment, and regional development could help unlock untapped potential across the country. Productivity is more than just an economic metric. It reflects how effectively a nation uses its talent, creativity, and resources. Strengthening it would not only enhance living standards, but also provide the foundation for long-term growth and resilience in an increasingly competitive global economy. Number 5. Energy prices and supply dependence. The surge in energy prices has become one of the most disruptive forces shaping the UK's economic outlook, exposing how deeply the nation depends on global energy markets. Over the past few years, spikes in oil and gas prices have rippled across every corner of the economy, from manufacturing and logistics to household expenses. Businesses have faced soaring production costs, while consumers have seen their utility bills reach record highs. For many families, this has meant choosing between heating their homes or managing other essentials, further tightening already stretched budgets. Energy-intensive industries, such as steel and chemical production, have been hit especially hard, forcing some companies to reduce output or even halt operations altogether. These rising costs feed directly into inflation, pushing prices higher for goods and services across the board. The UK's dependence on imported energy lies at the heart of this vulnerability. Limited domestic production, combined with a slow transition toward renewable sources, has left the country exposed to volatile global markets. When geopolitical tensions or supply disruptions occur, whether due to conflict, trade restrictions, or natural disasters, the UK feels the shock almost immediately. The lack of sufficient energy storage and long-term investment in local renewable infrastructure compounds the problem, keeping the economy tied to unstable international supply chains. This exposure undermines energy security, weakens industrial competitiveness, and adds uncertainty to both consumer and business confidence. To move forward, the UK must prioritise energy independence and sustainability. Expanding investment in renewable energy projects, such as wind, solar, and tidal power, could significantly reduce reliance on imported fuels. At the same time, modernising the national grid and supporting innovation in energy storage would create a more stable and efficient system. Strengthening domestic energy capabilities would not only help lower costs, but also create new jobs in emerging green sectors. Transitioning to cleaner, locally sourced energy isn't just an environmental goal, it's an economic necessity. By securing affordable and reliable energy, the UK can stabilise prices, protect households, and strengthen its position in the global economy for decades to come. Number 6. Brexit aftershocks. The aftershocks of Brexit continue to weigh heavily on the UK economy, shaping everything from trade flows to labour availability. While the 2016 referendum was framed as a path toward greater independence, the reality has proven far more complex. Businesses that once traded freely across Europe now face new customs checks, paperwork, and border delays, adding both cost and uncertainty. Exports to EU nations, the UK's largest trading partner, have slowed, while smaller companies struggle to manage the bureaucracy of international trade. This friction has weakened the competitiveness of many British firms, especially in sectors like agriculture, manufacturing, and retail, where profit margins are thin. The result is a steady erosion of trade efficiency and a loss of opportunities that once came from seamless market access. Another major issue tied to Brexit is the labour shortage that has disrupted multiple industries. The end of free movement from the EU reduced the inflow of skilled and semi-skilled workers who filled vital roles in construction, healthcare, logistics, and hospitality. As a result, many employers now face recruitment challenges, leading to rising wages that increase costs for consumers. These shortages have exposed how dependent key sectors were on European labour and how difficult it is to replace that workforce quickly. The strain has also discouraged some businesses from expanding, as uncertainty over immigration policy and workforce stability makes long-term planning riskier. This ongoing imbalance between labour supply and demand continues to pressure both productivity and service quality across the economy. To mitigate these lingering effects, the UK must focus on rebuilding trade partnerships and investing in homegrown talent. Simplifying export procedures, improving digital trade systems, and negotiating smoother agreements with EU neighbours could ease border friction. Simultaneously, investing in vocational training and education can help fill skill gaps domestically. Strengthening ties with non-EU markets may open new opportunities, but the key lies in stability and predictability for businesses. The Brexit transition represents a turning point. The UK now has the chance to redefine its economic identity. Whether it succeeds depends on creating an adaptable, globally connected system that balances sovereignty with sustained prosperity. Number 7. Housing crisis and skyrocketing rents. The UK housing crisis has evolved into one of the most visible symptoms of the nation's wider economic struggles. Over the past decade, property prices have soared far beyond wage growth, locking millions out of home ownership and placing intense pressure on renters. Rising interest rates have only deepened the issue, as mortgage costs climb and landlords pass those increases onto tenants. This has created a vicious cycle where housing consumes a growing share of household income, leaving less money for essentials and discretionary spending. For younger generations, the dream of owning a home feels increasingly distant, fueling frustration and eroding confidence in the economic system. As housing affordability declines, social inequality widens, and mobility between income groups becomes harder, further entrenching long-term economic divides. The shortage of affordable homes lies at the core of this crisis. Construction levels have failed to keep pace with population growth for years, constrained by planning bottlenecks, rising material costs, and limited land availability. Private developers often prioritise luxury projects, while public housing initiatives struggle with underfunding and bureaucratic hurdles. The result is a housing market that favours speculation over sustainability, where properties are treated more as investment assets than as essential living spaces. At the same time, high rents place strain on low and middle-income families, reducing their ability to save and invest in the future. This imbalance suppresses consumer spending, undermines productivity, and limits the flexibility of the labour market, as people find it harder to relocate for work opportunities. Addressing this crisis requires bold, long-term policy reforms that expand supply and stabilise costs. Encouraging investment in affordable housing, simplifying planning regulations, and supporting local councils to build more homes are crucial steps forward. Strengthening tenant protections and offering incentives for energy-efficient renovations could also ease pressure on households. A sustainable housing strategy would boost construction, create jobs, and stimulate broader economic growth. Beyond economics, solving the housing crisis would restore a sense of security and fairness for millions. A stable home market not only anchors families, but also strengthens the foundations of a resilient, inclusive economy capable of enduring future challenges. Number 8. Stagnant wages versus rising living costs. The gap between stagnant wages and rising living costs has become one of the most pressing issues dragging down the UK economy. While prices for essentials such as food, energy, and transportation have climbed steadily, average earnings have failed to keep pace. This widening imbalance means that even people working full-time often struggle to maintain their standard of living. The cost of living crisis has eroded household savings, reduced discretionary spending, and increased reliance on credit, leaving many families financially vulnerable. As consumers cut back on non-essential purchases, businesses experience weaker demand, creating a ripple effect that slows growth across multiple sectors. The result is a feedback loop where sluggish wage growth fuels lower spending, which in turn weakens business revenues and limits the ability to raise wages further. One major factor behind stagnant wages is low productivity growth combined with rising operational costs. Many companies, especially small and medium-sized enterprises, face tighter profit margins due to high energy prices, supply chain issues, and increased borrowing costs. With the limited financial flexibility, these firms often freeze pay increases or offer minimal raises that fail to offset inflation. Meanwhile, the labour market remains uneven. Some sectors struggle with worker shortages and higher pay demands, while others are oversupplied and stagnant. This imbalance distorts wage dynamics and reinforces inequality, particularly between high-income and low-income groups. Over time, this pattern erodes public confidence as people feel their hard work no longer leads to tangible improvement in quality of life. Reversing this trend demands a strategic focus on wage growth and economic fairness. Strengthening worker skills through training, promoting fair pay standards, and supporting industries that add real value could help shift the balance. Businesses need incentives to invest in innovation and productivity, which ultimately allows wages to grow sustainably. Policymakers can also ease the burden by reducing regressive taxes and improving access to affordable childcare and housing, freeing up more disposable income for families. When wages rise in line with productivity, it stimulates spending, boosts morale, and creates a more balanced economy. Ensuring that prosperity is shared fairly is not only a moral goal, but a cornerstone of long-term economic stability. Number 9. High national debt and government borrowing. The UK's rising national debt has become a defining challenge for policymakers and a growing source of concern for investors. Following years of economic shocks, from the global financial crisis to the pandemic and the energy crunch, government borrowing has reached record levels. Massive spending on public health, welfare programs, and energy subsidies provided short-term relief, but left lasting fiscal scars. The government now faces a difficult balancing act, reducing debt without stifling growth. High borrowing costs, driven by elevated interest rates, mean that a larger share of public funds goes toward debt repayments rather than essential services. This leaves less room for investment in infrastructure, education, or healthcare, sectors crucial for future prosperity. The strain on public finances also weakens the UK's fiscal credibility, making investors more cautious and increasing the cost of further borrowing. A major consequence of rising debt is the pressure it places on public services and taxpayers. When interest payments consume billions of pounds each month, governments are forced to make tough choices. Either raise taxes, cut spending, or borrow even more. Each option carries economic and political risks. Cutting spending can slow growth and deepen inequality, while raising taxes can dampen consumer confidence and business investment. Borrowing further may offer temporary relief, but ultimately feeds into the same problem. This cycle erodes trust in fiscal management and creates uncertainty that ripples through financial markets. Moreover, high public debt can limit the government's ability to respond effectively to future crises, leaving the economy more vulnerable to shocks. Addressing this issue requires a measured and forward-thinking approach to fiscal policy. Rather than relying solely on austerity, the UK could focus on boosting revenues through sustainable growth and innovation, encouraging private sector investment, expanding green industries, and supporting small businesses can help increase tax receipts without excessive strain on citizens. Transparent budgeting and long-term financial planning are equally vital for restoring market confidence. A credible commitment to managing debt responsibly, while still nurturing growth, would send a strong signal to investors and the public alike. Reducing debt sustainably isn't just about balancing books. It's about rebuilding economic stability and ensuring a stronger foundation for the future. Number 10. Political instability and policy U-turns. Persistent political instability has been a major drag on the UK economy, creating uncertainty that discourages investment, weakens the pound, and undermines long-term planning. Over the past decade, the country has seen frequent leadership changes, shifting fiscal priorities and abrupt policy reversals that have left both domestic and international observers questioning the government's direction. Each new administration brings a different economic vision, sometimes reversing decisions made just months earlier. These constant U-turns make it difficult for businesses to plan effectively, as they must continually adapt to evolving regulations and tax frameworks. Investors, too, become wary of committing capital when the policy landscape can change overnight. This volatility translates into slower growth, weaker productivity, and reduced confidence across financial markets. The impact of inconsistent policymaking reaches far beyond Westminster. Small and medium-sized enterprises, which make up the backbone of the UK economy, often bear the brunt of sudden regulatory changes. Unpredictable tax rules, fluctuating business rates, and unclear post-Brexit trade guidelines have made long-term strategy nearly impossible for many firms. Larger corporations, meanwhile, seek stability by redirecting investments abroad, draining the domestic market of both talent and opportunity. This stop-start approach to governance also discourages innovation, as entrepreneurs hesitate to take risks in such a volatile environment. Even public services feel the strain when funding priorities shift from one government to the next, delaying progress on crucial infrastructure and social projects that drive long-term growth. Restoring stability requires consistent, transparent, and evidence-based policymaking. Governments must commit to long-term economic strategies that outlast political cycles and build trust with investors, businesses, and citizens. Establishing independent oversight on key fiscal decisions and maintaining clear communication can help reduce uncertainty and prevent knee-jerk reactions that shake markets. Stability doesn't mean avoiding change. It means implementing it with clarity and purpose. When businesses and investors believe that the rules won't change overnight, confidence returns, innovation thrives, and growth becomes sustainable. A steady political environment is more than a matter of leadership. It's the foundation upon which a resilient and prosperous economy is built. The story of the UK economy is not one of sudden collapse, but of slow and complex strain. From political instability to rising debt, every factor we've explored connects to a broader cycle of uncertainty that touches businesses, workers, and households alike. Yet within this turbulence lies potential, the chance to rebuild smarter, fairer, and stronger. Real recovery depends on stability, innovation, and the courage to invest in long-term growth rather than short-term fixes. The challenges are undeniable, but history shows that resilience often emerges from adversity. The UK has weathered crises before, and with the right focus, it can do so again. As citizens, consumers, and professionals, awareness is our first tool for change. Understanding these issues empowers us to make informed decisions, whether in business, policy, or everyday life. The economy is not just numbers on a chart. It's the reflection of millions of people striving for security and opportunity. By demanding accountability, supporting innovation, and valuing sustainable progress, everyone can play a role in shaping a more stable future. If this video helped you see the bigger picture behind the headlines, hit like, subscribe, and turn on notifications for more insights into global and financial trends. Share your thoughts in the comments. Do you believe the UK can bounce back from these challenges, or is deeper reform needed? And don't miss our next video, how inflation quietly redefines everyday life. Together, we'll keep uncovering the real forces shaping our world.